Hey everyone, welcome to another video. In this video, we'll talk all about index funds. That is, what are index funds? What are the positives or advantages of investing or using index funds? And finally, when compared to mutual funds, how good or better they are. So first things first, and that is, what are index funds? Well, typically in the country, there are two prominent indices. One is called the Nifty 50, which relates to NSE or the National Stock Exchange, on which the country's top 50 companies in terms of the floating market capitalization are being listed. And then you have Sensex, which relates to BSE or the Bombay Stock Exchange. So these two indices put together give you a reference standpoint on how the whole stock market of the country is behaving or performing. And therefore, index fund is a fund which tracks the movement of the index or which moves in the same direction of the index, whether it is Nifty 50 or Sensex. Let's say RIL or Reliance Industries Limited has a proportion of 20% in the Nifty 50 index, and therefore for every 1000 rupees you invest into the index fund, 200 rupees will be invested towards RIL. Similarly, for every amount of investment into index funds, the proportion investment into different companies will be in the same proportion as it's listed on the Nifty 50 index. Well, coming and jumping straight into advantages. When compared to active funds and mutual funds, what are the advantages one by one? The first one is investment strategy. Now, as far as active funds or mutual funds are concerned, the investment strategy is to actively buy and sell mutual funds because you have a fund manager through whom you are investing into mutual funds. He or she may tell you that, okay, this is the fund in which you should invest and this is the fund from which you should redeem and then reinvest. As far as index funds are concerned, it is quite simple because the strategy here is to just replicate the market, whether it is an investment into the Nifty 50 index or Sensex. Coming to the goal or the fund objective, well, the objective of active funds is to always beat the benchmark or always beat the market returns. But as far as index funds are concerned, it is to always go in par or align to the performance of Nifty 50 or Sensex. Performance on a similar note, as far as active funds are concerned, the performance could be below the benchmark or above the benchmark, that is below or above the average market returns. And as far as index funds are concerned, it will be definitely equal to the index performance. Whatever is the performance of Nifty 50 or Sensex or the entire stock market as a whole will be the same performance of the index fund. And finally, this is the most important advantage, and that is expense ratio and risk. As far as mutual funds or active funds are concerned, the expense ratio is quite high because there's some amount of risk involved and some amount of technicalities involved in investing in this particular fund. But as far as index funds are concerned, the expense ratio is quite low, maybe 0.01%, because it is cheaper, there is less thinking to do in this type of fund, and it is less riskier also. Now I have here a screenshot of a particular index fund. This is the ICICI Prudential Nifty 50 Index Direct Growth Fund. Here you can see there are 50 holdings, of course, and you have the top 50 companies and the proportion of the assets. For every 1000 rupees you invest, what is the proportion investment into different companies is shown here. And of course, the instrument or the type of investment all are equity. So it's not that it will be totally debt or totally equity. You can always have a proportion, but mostly the index funds will be through the equity instruments. That is why you see here in this particular ICICI Nifty 50 index fund, the almost 100% of investment is into equity instruments. Now, the obvious question here is, okay, which is better? Do you have to go for active funds, mutual funds, or index funds? Well, that depends from investor to investor or your investment strategy. But one thing is sure, that today you have the rise of passive funds. In fact, if you look at mutual funds itself, there are three main types of mutual funds. You have small cap, mid cap, and large cap. So in the last 5 years, 10 years, the performance of large cap mutual funds is below par or is less than the performance of index funds. So index funds are performing much better than these large cap mutual funds. If I look at some statistics in the last 4 years, the growth of index funds have almost doubled from 8% in August 2020 to almost 16% 4 years later in August 2024. And as far as the amount of investment or AUM is concerned, from 7.58 trillion rupees in 2020 to almost 10.9611 trillion rupees in August 2024. This shows you the interest shown by the investors as far as investing in index funds are concerned today. Well, I hope I was able to make things clear through this particular video. If you like this short video, please do show your support to us by hitting the like button. If you want more videos like these on a regular basis through way of notifications, you could also think of hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.